if you're listening to this, chances are you or, someone has faced that creeping stress of consumer debt.
Mm-hmm.
We're talking about the whole stack here.
Yeah.
Home loans, credit cards, student loans, those medical bills that come out of nowhere, car loans.
Right. It's a landscape that's just so vast, and it's filled with confusing acronyms, DMPs, CCAs, 1099-Cs. It's a lot.
It is. And it feels like when you need help the most, you just get paralyzed by the sheer number of solutions being thrown at you.
That paralysis is completely understandable, and it's precisely why we're doing this deep dive today.
Okay.
Our mission is to, cut through all that noise and clarify the three most critical but often muddled ways of managing debt: credit counseling, debt management plans, and debt settlement.
And we're not just giving definitions here, are we?
No, not at all. We are putting these modern tools into the essential, broader context of historical and global debt relief, so you know exactly which path is being offered and, more importantly, what it actually means for your future.
So the learner's goal here is simple, but I think really profound. It's to walk away with a clear, critical understanding of the core differences between these things.
Exactly. And the regulatory complexities, they're different everywhere. The US, UK, Canada, South Africa, the EU.
And to really appreciate why this idea of debt forgiveness is such a powerful, centuries-old idea, we want you to gain knowledge quickly, but also, thoroughly, with total confidence.
Let's start with an origin story for one of these, because the context is pretty revealing. When we talk about modern credit counseling, most people assume it was born out of some consumer advocacy movement.
Right, that it was a grassroots thing to help people.
But the truth is, the initial push actually came from the creditors themselves.
Okay, let's unpack that. We're talking about the mid-1960s, a time when consumer debt and personal bankruptcies were really starting to spike in the United States. So who initiated what we now call credit counseling?
It was the creditor banks and the credit card companies. They were facing a serious dilemma.
Which was?
Well, as more and more consumers defaulted, their own risk exposure was just ballooning. Personal bankruptcy was costing them a fortune.
So they created a system to manage their own risk.
Exactly. They created a systematic mechanism, the credit counseling agency, to manage that risk. Essentially, they built a pipeline to get debtors back into repayment, even at a reduced rate, rather than losing the entire principal in bankruptcy court.
That feels like a critical piece of the industry's DNA right there. I mean,
Well,
if the tool was invented by the entity that's owed the money, doesn't that inherently create a conflict of interest?
it does.
Does it ensure that the debt management plans kind of benefit the creditor just as much as the debtor?
It creates a fundamental tension that you, the consumer, have to be aware of. Now, while many reputable credit counseling agencies operate as legitimate nonprofits with the consumer's interest at heart, the system's foundation is still built on the premise of repayment. It favors a path that keeps the money flowing back to the original lender, just with more manageable terms, and that context is absolutely key when you compare it to a strategy like debt settlement, which is aiming for outright cancellation.
Repayment versus cancellation. That distinction sets the perfect stage for our first major section. So let's nail down the definitions of these primary tools. Let's start with credit counseling. What's the process designed to accomplish, and what's its main deliverable?
Credit counseling, or what they call debt counseling in the UK, is a pretty holistic process. It's designed to arm the debtor with the tools they need to overcome financial difficulties for the long term.
So it's about more than just the immediate problem.
Oh, absolutely. This involves personalized financial education, robust budgeting instruction, and most often using a debt management plan, or DMP. The ultimate goal isn't just to survive the debt today, but to achieve debt elimination permanently by changing financial habits.
And who is providing this service? I mean, are these the companies you see in those high-pressure late-night TV ads?
Not typically, no. Not if you're seeking legitimate help. The reputable credit counseling agencies, or CCAs, are usually nonprofits.
Okay.
They operate with low, sometimes minimal, fees, and they're supported partly by what are called fair share contributions from creditors who benefit from the repayment stability.
So the creditors actually help fund them.
They do. And these agencies are staffed by certified counselors who have specific training in consumer credit, money, and debt management and budgeting. That certification and the nonprofit status, that's your first vital sign of legitimacy.
So if a certified counselor recommends one of these DMPs, how does that actually work in practice for someone's unsecured debt like their credit cards or old medical bills?
The debt management plan is really the workhorse of credit counseling. The CCA acts as the intermediary. They negotiate an agreement with your creditors to reduce your outstanding unsecured debts over a fixed time, typically 3 to 5 years.
How do they reduce the debt?
The relief usually comes from securing a dramatically lower interest rate. We're talking about dropping high-rate credit cards to single digits or, in some cases, even zero. They also get late fees waived, and sometimes they can extend the repayment term.
So for the consumer, it's a huge simplification.
Exactly. Instead of juggling, say, 6 different credit card bills with different rates and due dates, the consumer makes one single consolidated monthly payment to the CCA.
And the agency handles the rest.
The agency handles the timely distribution of those funds to all the enrolled creditors. It stabilizes your financial life, it reduces the total cost of repayment, and very importantly, it's a structure the creditors have already approved.
Okay, that brings us to the crucial pivot point. If DMPs are all about structured repayment, working with creditors and getting their approval up front, how radically different is debt settlement?
Debt settlement, which is also called debt negotiation or debt reduction, is philosophically opposite.
Opposite how?
It's not about managing repayment. It is about outright cancellation. This strategy aims to negotiate a settlement, which is a lump sum payment that's significantly less, maybe 40 to 60%, than the full amount you owe.
And these are usually for-profit companies.
Almost always, which should immediately signal a difference in motive and, how they operate.
So the core objective is partial forgiveness. That sounds great on the surface, right? So why is this considered the high-risk option?
It's because of the risk that's inherent in the process itself. When you enter a DMP, collection efforts generally stop because the creditors approved the plan.
Right.
In debt settlement, to force the creditor's hand and prompts a serious negotiation. The settlement companies routinely advise clients to start making payments entirely.
Wait, they tell you to just stop paying your bills?
Yes. This intentional default is necessary because creditors typically won't even consider negotiating a settlement unless the account is far past due and nearing what's called charge-off status.
I have to stop you there. If a client is told to actively default, essentially destroying their credit in the short term, are there ethical concerns about a professional company forcing that immediate damage just to open a negotiation?
Oh, it absolutely raises ethical red flags, and it has been the subject of regulatory scrutiny all over the world. The issue is that the consumer, while they're holding back payments, is now highly vulnerable.
Oh, so
While the settlement company is collecting funds into an escrow account, waiting to get enough cash to make that lump sum offer, the client is subject to aggressive collection efforts, major negative credit reporting that lasts for years, and critically, the immediate risk of a lawsuit.
So until a deal is made, you're totally exposed.
Completely. Until that deal is officially agreed upon and the lump sum is paid, those accounts are in default, and the debtor is exposed to the full legal weight of the creditor.
That is the crucial piece of information you need to internalize. Settlement involves actively defaulting to spur negotiation, which opens you up to collections and serious legal risk. Shifting gears a bit, let's explore how a certified counselor actually guides you through that safer, more structured process of credit counseling in practice.
It sounds like the first step isn't just signing up for a DMP, but more of a deep diagnostic review.
Precisely. The initial consultation with a reputable CCA is comprehensive. The certified counselor sits down with you. It could be in person, online, or by phone, and they review your entire financial life.
Everything.
Everything. They look at income, necessary expenses, your total debt load, interest rates, long-term goals. The counselor is trained to look at the whole picture, not just the symptom of, overwhelming debt.
And based on that, they might recommend the debt management plan for your unsecured debts. This involves developing the repayment plan, setting that single payment, and handling the distribution. In the U.S., the government has explicitly endorsed this kind of counseling in one specific high-stakes scenario. That's right. For any individual filing for either Chapter 7, that's liquidation, or Chapter 13 reorganization bankruptcy in the United States, receiving credit counseling is a legal prerequisite.
It's required by law.
Yes. It's baked into the U.S. bankruptcy code, and that requirement really underscores the regulatory belief that financial education and a third-party review are essential parts of getting debt relief through the court system.
So DMPs are the core tool, but not every debt problem requires a formal multi-year plan. What are some of the other alternative lower-risk strategies a counselor might recommend?
Yeah, counselors are trained to offer a menu of options. One common strategy is debt consolidation.
How's that different from a DMP?
Instead of formally enrolling in a DMP, this involves replacing multiple unsecured debts, say 3 different credit cards, with one single new loan, ideally with a lower overall interest rate and a single fixed payment. This is often done with a personal loan from a bank or a credit union.
And then there is that psychological game changer, the budgeting method, that focuses on motivation rather than just pure interest rate optimization.
You're talking about the debt snowball method.
Exactly.
This is a systematic, highly behavioral approach. The consumer lists all their debts from the smallest balance to the largest, ignoring the interest rates, at least initially.
And you tackle the smallest one first.
You focus all your available extra funds on paying off the smallest debt first. This provides an immediate quick win and a surge of psychological momentum.
Why does that quick win matter so much?
Because paying off debt is a marathon and burnout is incredibly common. When that smallest debt is eliminated, the full payment amount that used to service it is not suddenly spent. It gets rolled over and applied to the next smallest debt.
So it accelerates.
It accelerates repayment and builds incredible adherence. The psychological benefit of seeing debts disappear quickly often outweighs the marginal financial benefit of prioritizing the highest interest rate debt first, which is the alternative, the debt avalanche method. The snowball is all about sustained motivation.
And finally, let's touch on a strategy for older homeowners who might have a lot of assets tied up in their homes but need liquid cash.
That leads us to reverse mortgages. This allows homeowners, typically those 62 and older, to access the equity they've built up in their homes without taking on a traditional mortgage payment.
How does that work?
The loan amount is usually paid out as a lump sum or a line of credit or monthly installments. Crucially, the repayment of the loan plus all the accumulated interest is deferred until the homeowner dies, sells the home, or moves out. It provides liquidity without creating a new monthly bill.
So legitimate credit counseling provides verified, low-fee, tailored solutions. But we've established that the line between helpful advice and exploitation can be pretty thin. What are the major warning signs, globally, that consumers need to watch out for?
The criticism largely targets these predatory entities that are masquerading as CCAs or debt reduction firms. The most common warning signs are all about fees and transparency. Consumers have to watch out for companies that charge unlawful or unreasonable fees, especially any significant fees before services are rendered. A huge red flag is a company that fails to meet required professional standards, or critically, one that neglects to inform you that free debt services are available.
Right. If an agency doesn't tell you that there are free, government-sponsored alternatives in your region, that lack of transparency should immediately make you skeptical.
Absolutely. The goal of a legitimate nonprofit CCA is to help you achieve financial stability, even if that means referring you somewhere else. A profit-driven or predatory model is designed to keep you on their specific, expensive service track, no matter if a cheaper or free option is better for you.
That sets the stage perfectly for our deep dive into the high-stakes world of debt settlement. This is where the consumer is looking for cancellation, a fresh start, not managed repayment. So walk us through the actual mechanics of negotiation and agreement.
The settlement process begins with that intentional stopping of payments, as we discussed. Once the account is severely delinquent, the debt settlement company approaches the creditor, or maybe the collection agency that has purchased the debt, to negotiate a lump sum payment that will satisfy the obligation.
So the creditor agrees to forgive a big chunk of the debt.
A large part, often 40 to 60%. And once the settlement terms are agreed upon and finalized in writing, the debt is canceled as soon as that lump sum is paid.
And to be clear, what specific types of debt are we usually talking about here?
We are focusing strictly on unsecured debt. So that means credit card balances, personal loans, certain types of medical bills.
And what's excluded?
Almost always excluded are secured debts, mortgages, car loans, and famously in the U.S., public student loans. These debts have specific collateral or are protected by federal law, making them resistant to this kind of simple negotiation.
So why would a major bank, which loaned me, say, $10,000, agree to accept $5,000 back? It seems like a terrible business decision on their part.
It's pure economic calculation, and it's based on the ultimate threat, bankruptcy. The creditor's primary incentive is to secure any funds they can, rather than risking the consumer filing for Chapter 7 bankruptcy. In Chapter 7, the creditor often recovers little to nothing. Taking 50 cents on the dollar now is far preferable to the strong possibility of recovering zero later.
So the negotiation is basically a high-stakes calculation by the creditor.
Exactly. They're weighing the cost of bankruptcy court against a guaranteed recovery percentage.
Now, consumers can try to negotiate themselves, or they can use these professional firms. What are the concrete advantages that professionals claim to offer that might justify their pretty substantial fees?
Professional debt settlement companies offer, well, speed, expertise, and a shield. They often negotiate better rates, sometimes achieving settlements as low as 15 to 60% of the existing balance.
Why can they get better rates?
They argue they can do it quicker because of established relationships and bulk negotiation power. But maybe the biggest practical advantage for the debtor is the handling of collection calls. For someone facing a barrage of hostile calls, having a professional firm step in and handle all communications is a massive psychological and logistical relief.
Let's talk about the cost. Since that 2010 regulatory shift in the U.S., how are these companies allowed to charge their fees?
The key is the Federal Trade Commission, the FTC, regulation from 2010. Legitimate U.S. settlement companies are strictly prohibited from charging any upfront fees.
None at all.
None. Fees can only be collected after two conditions are met. The settlement has been successfully reached with the creditor, and the debtor has made at least one payment toward that finalized settlement.
And what's the range of those back-end fees?
They can be substantial. They range from 10% to as high as 75% of the total amount of debt to be settled. So if you settle $10,000 of debt and the fee is 25%, you owe the settlement company $2,500, often taken right out of that dedicated escrow account.
So you have to calculate if the reduction is really worth it after the fee.
You do, especially when you factor in the credit damage and the potential tax issues.
Speaking of credit damage, this is guaranteed. How significant is the impact on your score and your credit history?
It is severe and it is immediate. Intentionally stopping payments to prompt a negotiation can easily drop a credit score by 65 to 125 points very quickly.
And that has real-world consequences.
Oh, immediate ones. That kind of drop doesn't just look bad. It can prevent you from leasing an apartment. It can significantly raise the interest rate on any existing loans you have, like a car note, or make it impossible to qualify for good terms on a new cell phone contract. And the damage is lasting. Missed payments, even after the debt is successfully settled, remain on a consumer's credit report for 7 full years.
So even a successful settlement is a 7-year commitment to a damaged credit profile. Now, let's dive into the absolute worst-case scenario here, the thing that catches people totally off guard, the tax implications. What is the infamous Form 1099-C, and why is it often called the tax bomb of debt settlement?
The 1099-C is critical to understand. U.S. tax law says that any debt forgiven, if the amount is $600 or more, and it happens outside of a formal bankruptcy proceeding, is generally treated as taxable income by the IRS.
Taxable income.
Yes. When a creditor forgives debt, they have to file a Form 1099-C reporting that canceled debt to both the IRS and to you, the taxpayer.
Wait, hold on. So I successfully negotiated away $15,000 of credit card debt. That $15,000 is now treated as if I earned $15,000, potentially pushing me into a higher tax bracket and sticking me with a huge, unexpected tax bill the next April.
That is the consequence, yes. The forgiven debt increases your gross income. The IRS treats it this way because the debt relief technically increased your net worth. You suddenly have assets that don't have an equivalent liability.
That significantly changes the math on whether settlement is truly a discount. Is there any way to escape this tax consequence?
There is one major exclusion available: insolvency.
Insolvency.
Yes. The IRS understands that taxing someone who is still fundamentally broke, even after the debt is canceled, is punitive. So if you were insolvent at the moment the creditor forgave the debt, you can exclude the canceled amount from your taxable income.
Okay, so how does the IRS define insolvent, and what does the debtor have to do to prove it?
Insolvency means your total liabilities. So everything you owe are greater than your total assets. Everything you own, like cash, bank accounts, investments, property value. To claim this exclusion, you have to file IRS Form 9802, Reduction of Tax Attributes, due to discharge of indebtedness.
And that's not simple.
No, this form requires you to clearly demonstrate your balance sheet assets versus liabilities at the exact time the debt was canceled. It's a complex calculation, and it often requires professional tax advice.
Can you give us a quick practical example of that calculation? Because it sounds like it's not always a clean one-to-one exclusion.
Sure. Let's say you have $20,000 in assets, but you owe $35,000 in liabilities. You are insolvent by $15,000.
Okay.
Now, if your creditor cancels $18,000 of debt, you can only exclude the first $15,000, the amount of your insolvency, from your taxable income.
And the other 3,000.
The remaining $3,000 of forgiven debt must still be reported as taxable income that year. This complexity is why proceeding with settlement without understanding the 1099-C and Form 982 is incredibly dangerous.
That is the ultimate warning. Finally, what does the data tell us about how reliable debt settlement is? I mean, does it actually solve the problem?
Well, the data suggests this has limited success for total debt elimination. For example, a report from the Colorado Attorney General found that after 3 years, only about 11% of consumers who had enrolled had settled all of their debt.
Only 11%.
While other studies show a higher percentage of accounts settled, it often leaves some lingering debt or debt that has moved on to litigation. And you have to remember, this industry has also faced major legal scrutiny. The New York Attorney General issued subpoenas regarding fraudulent practices way back in 2009. The cultural recognition of the struggle is high, but the success rate for comprehensive safe relief is often pretty low.
That proven need for rigorous oversight brings us perfectly to how these services are policed around the world. Given the high stakes, the predatory potential, and the tax implications, who is watching the watchers? Let's start with the complicated multi-agency structure in the United States.
The U.S. structure is very decentralized. It involves federal, state, and professional layers. At the federal level, you have the FTC, which enforces consumer protection, especially regarding deceptive advertising and that upfront fee ban we just talked about.
Right.
The IRS, because of the 1099-C, acts as a sort of indirect regulator. And the U.S. trustee program is involved because of that legally mandated credit counseling requirement for anyone filing for bankruptcy.
And then the states fill in the gaps.
Exactly. State attorneys general are crucial for prosecuting fraud, but the regulatory patchwork is very real. Some states require licensure and actively limit the fees that agencies can charge, offering strong consumer protection. Other states have, well, virtually no laws directly regulating the industry, which creates really uneven protection across state lines.
This sounds like a system where professional adherence is sometimes more reliable than actual legal mandates. What role do the self-regulatory bodies play?
They're vital. They're referral points for consumers who are seeking trustworthy help. We have the National Foundation for Credit Counseling, NFCC, and the Financial Counseling Association of America, FCAA.
And what do they do?
They're membership organizations that set rigorous ethical standards for their member agencies. They require specific training, nonprofit status, and compliance oversight. If you are looking for a CCA, starting with an NFCC member agency is a really important due diligence step.
Let's move to the United Kingdom, where the regulatory structure seems much more consolidated and, frankly, more powerful.
It is. In the UK, the regulatory body is the Financial Conduct Authority, the FCA. They regulate all consumer credit activities, including debt management services. The FCA has established a specific debt management plan protocol, which ensures standardized practice.
And they have teeth.
They have significant power. Because they are the ultimate regulator, they can levy massive fines, demand compensation for harmed consumers, or even revoke a firm's authorization to operate if they engage in improper conduct. This centralized authority provides a much stronger layer of enforcement than the U.S. patchwork system.
Now, looking across the massive market of the European Union, regulation is naturally widely varied among the member states. Can you give us a few examples of how different nations approach this problem?
The variation is fascinating. In some EU countries, the intervention is less formal government regulation and more institutional support. Take Sweden, for example.
Yeah.
The Swedish Confederation of Professional Employees provides TCO guidelines that creditors are encouraged to follow, acting as an alternative to immediately pushing debtors toward the court system.
So it's professional bodies and labor groups stepping in.
Exactly. In Ireland, the Irish Congress of Trade Unions provides direct debt resolution information to debtors.
So again, labor is filling the gap where state regulation might be light.
Precisely. And then you have these unique employer-centric models, like in Latvia, where a debt advisory company called LERA works directly with large employers to assist their indebted employees.
That's interesting.
Yeah, it recognizes that employee debt is often a workforce productivity issue, and intervention is financially beneficial for the employer as well. It's a highly diverse system relying on different societal levers.
Moving over to Canada, what is the core advice and caution offered by their financial consumer agency, the FCAC?
The FC8 takes a strong consumer protection stance. They urge Canadians to verify the trustworthiness of any organization offering help. They specifically warn against fraudulent claims, the red flags being representations that sound too good to be true.
Like what?
Like a guarantee to quickly fix your credit score, claims to be part of a government program, or offers to repay only a tiny fraction of the debt.
And they also stress a crucial legal distinction about bankruptcy, similar to the U.S.
They do. The FCSE emphasizes that only a qualified, licensed insolvency trustee can legally help a Canadian file a formal consumer proposal or file for bankruptcy. Consumers need to be extremely wary of companies claiming they can handle these specific legal processes without that official designation,
because they're likely operating outside the law.
and can lead to disastrous outcomes.
Finally, let's look at South Africa, where, as you mentioned, the terminology itself signifies a huge difference in legitimacy. Why is debt counseling legally recognized there, while credit counseling is often associated with scams?
This is a perfect example of how language really matters in regulation. The industry in South Africa is overseen by the National Credit Regulator, or NCR. Following their National Credit Act of 2005, debt counseling was introduced as a formal, legally recognized process in 2007.
So what does that legal recognition mean for the consumer?
It means that once a consumer applies for debt counseling, legal action against them by creditors is temporarily halted. The consumer is protected while a court-approved repayment plan is developed. It's a standardized, legally sanctioned procedure.
And credit counseling.
Conversely, the very similar-sounding term, credit counseling, is often used by unregulated or unregistered services that don't offer that legal protection or follow the rigorous standards set by the NCR. It leads to consumer complaints and failed repayment efforts. The subtle difference in name signals the difference between legal protection and a potential scam.
That is an excellent summary of the regulatory geography. The message is universal. Legitimacy is paramount, and verification is mandatory. We focus so heavily on modern transactional solutions, but this concept of debt relief, of hitting the financial reset button, is not a modern invention at all. It is foundational to human society, dating back thousands of years. Let's dive into the history of personal forgiveness, starting with the biblical and Near Eastern context.
This deep history really reveals that societies understood from very early on that unmanageable debt destroys social cohesion. The most famous example is in the Judeo-Christian scriptures, specifically the book of Leviticus, which outlines the institution of the Jubilee year.
The Jubilee year.
Right. This required debt forgiveness every 7 agricultural years, or sometimes every 49 years. The idea was to prevent perpetual poverty and the permanent stratification of society based on economic failure.
And this wasn't just an isolated idea among the Israelites.
Not at all. We find parallel practices across ancient Near Eastern civilizations. For instance, the ancient Hittite Hurrian text, the Song of Debt Release, discusses debt cancellation. Rulers across Mesopotamia would often declare clean slate edicts to restore economic balance and prevent widespread revolt by freeing people from accumulating liabilities.
But the most radical and maybe the most famous example of governmental debt relief comes from ancient Athens in the 6th century BCE. Tell us about Solon Siatea.
Solon's reform, Seistheia, which literally means shaking off of burdens, was truly revolutionary. The debt crisis in Athens had led to a huge portion of the population being reduced to debt slavery or serfdom.
And his solution?
Solon's legislation canceled all outstanding debts, public and private, and retroactively freed every single person who had fallen into debt slavery.
So that sounds like a total societal restructuring. What was the lasting impact?
It fundamentally paved the way for Athenian democracy. By eliminating the economic subordination of the lower classes, Solon enabled a broad base of citizenship and political participation. It's a powerful historical testament to debt cancellation being used not just as economic relief, but as a critical tool for political and social engineering.
We also see this moral imperative for debt forgiveness reflected in other major religious texts, including the Quran.
Absolutely. Islamic scripture supports the remitting of debt by way of charity for debtors who are in genuine difficulty. Quran 2.280 is explicit. If the debtor is in difficulty, grant him time till it is easy for him to repay. But if you remit it by way of charity, that is best for you if ye only knew.
So it frames forgiveness as a virtue.
Not just as good economics, but as a deeply virtuous and charitable duty.
It's important to acknowledge the grim historical alternatives, too. What happens when systems fail to provide any relief?
When relief fails, the punitive measures take over. Historically, the most common consequence was debt bondage, including outright debt slavery, where individuals were bound to servitude until the debt was repaid. And although debt bondage was banned by a 1956 UN convention, it still tragically persists in certain countries today.
And debtors' prisons.
We also saw the rise of debtors' prisons, which, while largely abolished in modern Western law, are sometimes replaced by similar situations, like incarceration for failing to pay certain civil fines or child support.
Moving into more modern history, the U.S. actually pioneered a comparatively debtor-friendly legal approach to debt relief, though it faced a lot of political resistance.
It did. The U.S. system, compared to contemporary European systems, was relatively forgiving. The first federal bankruptcy law was enacted in 1841, though it was quickly repealed. But then it was reestablished and expanded in 1867. This structure allowed individuals, often motivated by debtor-farmer grievances against Eastern creditors, to legally wipe the slate clean in a court of law. This made the United States fundamentally unique in offering a formalized, systemic path for relief.
Let's look at a modern, policy-driven example of massive, systemic forgiveness. Not bankruptcy, but a correction of a failed policy, like the Texas driver responsibility surcharge repeal.
Oh, the Texas case in 2019 is a perfect example of what happens when a punitive financial law becomes counterproductive to public safety and justice. The driver responsibility surcharge was a civil penalty levied on top of criminal traffic infractions.
What was the problem?
The problem was most of the 1.4 million people assessed just couldn't afford the fine. The total debt accumulated to about $2.5 billion.
So instead of deterring bad driving, what did the law actually create?
It created a spiral of debt and incarceration. Because people couldn't pay the civil surcharge, their licenses were suspended.
But they still had to drive.
They still had to drive to work or take their kids to school, which led to more arrests for driving on a suspended license. Local sheriffs complained that the law was filling their jails unnecessarily with citizens who were simply too poor to pay a fine, not dangerous criminals.
So they got rid of it.
By abolishing the surcharge in 2019, the Texas legislature effectively canceled $2.5 billion in accrued debt, recognizing the policy had failed its stated goals and created a debt crisis for its poorest citizens.
That story really highlights the societal implications.
Yeah.
Shifting to international policy, let's discuss how systematic relief is applied to heavily indebted nations.
This is the realm of the Heavily Indebted Poor Countries Initiative, or HIPC, which was launched in the 1990s, and its successor, the Multilateral Debt Relief Initiative, or MDRI. The HIPC initiative provided systematic debt relief to the world's poorest countries, often contingent on them agreeing to spend the funds saved on poverty reduction and structural economic reforms.
And the MDRI took that a step further, correct?
Yes. Agreed upon at the G8 Gleneagles meeting in 2005, the MDRI offered 100% cancellation of multilateral debts. So debts owed to large institutions like the World Bank, the IMF, and the African Development Bank for HIPC countries that have met certain conditions.
And the rationale?
The global consensus was that for these nations to achieve long-term sustainability and meet the UN Sustainable Development Goals, total debt distress had to be eliminated.
Here is where that historical context meets modern data. What are the measurable outcomes when an individual receives debt relief today?
Recent studies from 2024 have provided some really compelling evidence. Debt relief for individuals isn't just a temporary fix. It leads to a large, sustained increase in their earned income, their employment stability, their overall assets, and wealth over the next decade.
So forgiveness acts as an economic catalyst, not just a simple handout.
The data strongly supports that. Another 2024 study even connected debt relief to political outcomes, noting that debtors who receive relief are statistically more likely to support incumbent governments, a strong political incentive for broad relief programs.
But there are nuances.
There are. We also have to look at things like a 2025 study on medical debt relief. That study found that while canceling medical debt dramatically reduced payments of existing bills and improved financial metrics, it did not lead to measurable improvements in the debtor's mental or physical health or their subsequent use of healthcare.
So the financial stress was lifted, but the health outcomes remained static.
Exactly. It's a subtle but incredibly important distinction. Relief fixes the financial symptom, but not necessarily the systemic health issues that caused the debt in the first place.
And finally, we should touch on the unintended relief that sometimes occurs through macroeconomic forces.
We're talking about unexpected inflation. While it's often called the hidden tax for savers, for existing debtors, inflation reduces the real value of the debt they owe.
How so?
When inflation outpaces the interest rate built into the loan, the debtor is effectively repaying the loan with money that is worth less than the money they originally borrowed. This force has historically created huge political tension, most famously in the late 19th century U.S. debate over the monetization of silver, where indebted farmers pushed for currency expansion to inflate away the real value of their debts to creditor bankers.
What a monumental journey, from Solon shaking off of burdens to the complexities of a U.S. tax exclusion form. Let's try to synthesize this vast landscape for you, the listener. If you are struggling with debt today, how do you match the right solution to your personal situation?
The synthesis really comes down to risk tolerance and your ultimate goal. If you're seeking structured repayment, long-term financial education, and a manageable path to eliminate debt while working cooperatively with your creditors.
The cooperative part is key.
It is. Then credit counseling and the debt management plan, DMP, are the preferred low-risk methods. This is your safe, systematic path to reducing fees and interest rates over time while maintaining the highest possible credit standing given your situation.
And what if my financial distress is more severe? I have significant unsecured debt. Maybe I have access to a lump sum and are prepared to take a major credit hit.
That is when debt settlement may become a strategic option, but you have to enter that process with your eyes wide open. It is a high-risk, negotiation-based strategy reserved for those who fully accept the severe implications.
Which are?
The guaranteed negative impact on your credit score for up to 7 years, the real legal risk of being sued while the account is in default, and the absolute necessity of understanding the complex tax consequences via that 1099 line C form and the insolvency exclusion calculation. Settlement is for the distressed debtor who is calculating the risk of court versus the cost of negotiation.
Perfect. Credit counseling for education and manageable repayment. Debt settlement only as a strategic, highly scrutinized negotiation tool. To close out this deep dive, let's revisit the sheer scale of the debt problem in the U.S. that makes these solutions so necessary, specifically the dramatic shift in how that debt is composed.
The data shows a frankly terrifying trend. Between 2003 and 2017, non-housing personal unsecured debt in the U.S. nearly doubled. It rose from roughly $2.05 trillion to $3.76 trillion. That staggering increase in leverage affects millions of lives.
And we can pinpoint the primary driver of that growth.
Absolutely. The composition shifted dramatically because of student loans. In 2003, student loan debt constituted only 12% of that total unsecured debt load.
Only 12%.
But by the third quarter of 2017, that figure had skyrocketed to 53% of the total. More than half of all unsecured debt held by Americans became student loan debt, a category that is notoriously difficult, almost impossible to discharge in bankruptcy.
So given that profound structural shift, and given the proven long-term economic benefits that studies show debt relief provides to an individual's earned income, employment, and overall wealth, here is the provocative thought we want to leave you with.
What is the optimal societal balance between the necessity of upholding contracts, which is the foundation of modern capitalism, and the moral, historical, and economic imperative of implementing systemic forgiveness when large portions of the population fall behind due to uncontrollable financial trends like hyperinflation and higher education costs and increasing consumer leverage?
It's a tension that has defined society since the time of Solon, and one that modern policymakers and you, the taxpayer, will continue to grapple with as we seek to unlock productivity while managing mass financial distress. Thank you for joining us on the Deep Dive. We hope this has given you the clarity and confidence you need to navigate these critical financial decisions.